So gold has become a monster for about a year and a half now, and it peaked in January 2026 to 5,400, 5,600 at a certain spike. And this thing put the industry into turmoil, which I don't recall lately. So we had position being hedged from 40 to 80 degrees. The whole portfolio changed, and we will discuss this in depth to see where we stand now, what caused it, and what can be done in the future to maybe not to prevent it, but to get to be better prepared to such a scenario. But maybe we can start with a short introduction, each and every one of you, and how you interact with gold on a daily basis.
Yeah, hi, I'm Stuart Brock at B2 Prime. Our business is probably the same as everybody else here, where we're seeing a large amount of gold. I think the average person is probably going to be seeing about 60, 70% gold as part of their portfolio that they're running on their books. So the way that we work, we are purely a STP, so slightly different, but we align with our customers. So our focus is basically giving the best price available to our customers, working with our liquidity sources to ensure that the price feeds that we're able to offer align exactly with their needs.
I'm Rowan of TradingView, and I'm heading business growth in the platform, which is perhaps the most objective reflection of retail user interest in the gold market. We've got over 40 data providers suggesting gold data, and over 25 executing partners on gold.
So, my name is Emmanuel. I'm the head of precious metals trading at Swiss Finance Corporation. We're a new entrant into the precious metals markets, but I've been in the metals market for 25 years, and I've built 3 separate precious metals businesses, more recently at Edgewater. I've started a new market-making business within this FCA-regulated broker based in London, Mayfair, and we're here to provide a unique price and offering that other liquidity providers are not offering at the moment. So that's my niche in the marketplace, and yeah, excited to be here. Thank you.
I'm Liam Smith, the Chief Operating Officer at 26 Degrees. We're a liquidity provider, global coverage. We're one of the earlier liquidity providers in the market, running a prime-to-prime model and also a price-making model. And as my role is sort of overseeing the operations for Europe and US for those markets and the coverage behind them.
So maybe we can go back to this, to these days back in January. How did you experience this peak? Was it a part of in your eyes, the rally that that started it, or was it some kind of like a snowstorm, perfect storm that ended up like it did in your eyes?
Yeah, absolutely. Like from the time that we were here last year to the end of January, we'd seen a 40% increase in the value of gold. Now that is down to a lot of macroeconomics, everything that's happening with different wars that have been happening around the world. And people are looking for a store of value. And what they're doing there is then moving the funds into gold. And that then becomes a sentiment-driven business, as opposed to it having anything to do with gold for manufacturing or jewelry. Yeah. It's now become this group here, everybody at the conference, with the sentiment of driving that business, the central banks who are then storing gold. And that's what we'd seen climbing all the way up until, as you said, to 5,500. And then as soon as we got to that number, it seemed there was a bit of a shift where maybe there's brokers out there or business who just say, I found my limit.
So up until that point, you think gold was still connected conceptually to the price of the real gold?
At the start it was, but then with the geopolitical business happening, then it became more of a sentiment. People wanting to put their business and move their funds out of the G10 products that they've been trading and then move that actually into gold. So what we had seen is, yes, there's a lot more gold being traded, but also a lot less of the other products.
Rowan, I think that TradingView is like the first place where you can sense the retail interest in such a scenario. So how did you experience it?
Yes, and here I'm keen to understand why the suggested timeline or the time mark is set at January 26, because from our platform perspective, we've crossed 100 million impressions or interactions with the gold globally for the first time in May 2026, and the user activity has been quite steady for the following 6 months. So think of June to December 26. It had indeed peaked in January 26, but we've only seen a 20% increase to the average of past 6 months. So nothing overwhelming. Perhaps that's different with the liquidity providers or with the brokerages. And now we are still above a 100 million interactions mark, which means the interest has been somewhat steady for the past 12 months with a 20% peak during the first quarter of this year, which suggests a different picture to how it would be seen if we would just be following the price action of the underlying asset. So we are not seeing as much of the peak like during the peak time, and I think it brings us to the understanding of retail trading behavior pattern, which is rather following the steady growth of the underlying asset. It's like something which is seen as the best possible price action for the for the retail side. So the clicking point has perhaps been the quick move from 2K to 3K, then and then when the most of user attention has already been absorbed. So my let's say if I may return a quick question to the rest of the panel, I would be happy to understand how much of the difference the first quarter of this year had brought to your products and to your lines of business, let's say as compared to the average of last year.
Yeah, look, I think January for me is just the tip of an iceberg, really. I don't think it really, it marks something on the brokers' books as being a big event, but really that has been culminating over the last 6 years. So if you have a look at the central banks have been buying gold since COVID. So that's all been happening under the surface, and the fact that retail brokers and maybe the retail market is suggesting that January was the move. It wasn't. That was just a powder keg ready to explode once Trump and geopolitical issues got involved. So I think that's the pinnacle. But really, what was happening over the last 3 years, the signals were there. We saw a massive dislocation in the forward markets over the last 24 months, both in silver and gold. We saw a huge amount of precious metals being shipped to COMEX to offset their exchange for physical between the futures and the spot market. So that has been accumulating for so long. So the signals were there, the forward market, the demand from the central banks, and it's all being really driven in terms of the price action by the OTC market, but really the direction of the price is coming from the physical market. So if you have a look at, historically speaking, the times of high demand is happening in the Indian Diwali season, which is coming up in October. That's going to continue. There's always a physical demand for that. The price action doesn't really come from the retail space, in my opinion, because that's generally unhedged. It's sitting in a B-book somewhere, so it's not participating in the real market. And yes, retail brokers, they're doing more hedging than they probably ever have, which is great for my business because I'm a liquidity provider. I hope you do more hedges, for a lot of you. And that's tapering risk. But I think Just watching the price action, we're coming towards American midterms in November, Diwali's in October, so I think there's going to be further price action demand. The other thing to realise is the rate that central banks have been purchasing gold over the last 6 years has been quite high. That started to taper a little bit, but still around 50% of the central banks are still signalling that they're buying gold. So that's bullish. There was a World Gold Council report that came out at the start of this month, which they surveyed the central banks, and 50% of them were signalling that there's still demand. So that's positive. Another interesting thing around the risk of the market is those same central banks are considering moving their gold holdings from overseas back to their home state. So that indicates that there's more risk in the market. They're worried that foreign entities or wars, the world's a more dangerous place these days. And so that just puts upward pressure on the gold price.
Yeah, I totally agree that the signals there were some signals there. I think for our space in the retail broking world, whilst the demand or the price action, as you say, Emmanuel, might not have been driven by it, that definitely influenced the sector. Like we saw an interesting early warning signal that we saw in January was the bank LPs and price makers rebasing their spreads to reflect the asset price shift so that they're maintaining the same dollars per million. And they do sort of always do that. We saw a similar shift in October when it first broke through 4,000, but January for us was they'd hit it at a different quantum. So that was an early signal to us that the banks were now taking a view, or they thought that this price range was around to stay. And then from the retail broker cohort that were hedging to us and through us, we definitely saw a long bias form around like the 10th of January that was outside of our typical baseline. And as well, we saw like intraday counterflow dry up. So not only were clients more long, there was definitely less netting flow between the broker or the retail clients, I'd say, sort of jumping on the price action that might have been driven from other markets.
So from an industry perspective, we know that it was said that several brokers nearly closed shop because of this event. So do you have any evidence or any knowledge about how things may have changed since then from the LP brokerage relationship?
Yeah, I've got an opinion on that.
Yeah.
I mean, Swiss Finance Corporation wasn't involved in the precious metals markets during January, but it's just like, it reminds me of the SNB, Swiss National Bank, when you are building large positions around a certain level. The market was either short or long, and it's the same thing here. And then, what do people do about it? They can either hedge it or they can use the other leverage, the levers to pull. And we did something really well at AxiTrader when I was there. We spotted a large Euro Swiss position which was building. There's nothing we could have done about it. It would have gone from positive to negative margin. And the only thing we could do was just increase internal margins. And I haven't seen brokers really do that. So you got spread compression, but the margins have kind of stayed the same. So if you look at 2007, I had an argument with my boss at the time, and I remember it clearly because gold was trading 5% margin, silver was 8% margin. Fast forward 20 years later, 2025, the margins were still the same, and yet the volatility and the ranges had dramatically increased. So if you think about everybody's saying that access to the markets is a positive thing. So we've got ETFs, we've got futures, we've got other derivatives, spot, you name it. There's many more ways to access the market now. However, there's no more liquidity. Gold is a finite resource. It's a scarce resource. The true liquidity providers are limited, and yet there's now a much larger access to the market, making that pull and push demand, supply. So we're going to see margins not really change. They haven't really changed. They should change. And I think brokers can use that as a lever to take people out of positions to reduce the risk.
Mm-hmm. And I think January, like the late sell-off or the sell-off in the last couple of days of January, were probably a saving grace for many brokers. But I think unfortunately that has taken the pressure off fixing the weaknesses that were identified. Mm-hmm. And I do think one of the key weaknesses is that margin, right? Like the brokers that sort of have a fixed low margin rate that is well inside the actual risk they're carrying, once they have had exposures built in their books larger than their balance sheets could facilitate or accommodate, and they needed to hedge, they found that a capital constraint was larger than they expecting because they weren't proportionally tiering up the margins on their client side. So I think my warning to retail brokers would be don't, because January saved the end, do a post-mortem and actually learn the lessons, because I think if it had held on if the price had rallied for even another day or two, I think this would be a very different situation right now.
I totally agree, and I wanted to ask Stuart if
I also agree. There's we had changed some of our margin rates around that time. We could see that this was all happening and taking place, and customers would initially be upset about the fact that margin rates were changing, and then after that happened, they came back and they were very thankful that we had changed the conditions that they were sat within.
But there's no long-term conclusion, you say, from this event.
It's a race to the bottom, right?
Yeah.
For the brokers.
Once everyone forgets about it, it's a race to the bottom.
Yeah. But what do you want to do? And we are very supportive of how do we have the business long-term, not just in for a good time, right? So we have to put the right conditions in place to protect our customers, protect our business, to make sure that we are consistent, we are stable throughout all of these trading conditions. But what we had seen is also a lot of widening the price. The market's the market. So we're having to work with our customers to understand exactly how they interact with the price feeds as well.
That's right. And margin's margin's a dirty word in the retail industry, which is a bit strange, because if you want to buy a house, you need to put a deposit. If you want to trade gold, you put a deposit down, and it's still your money. It's not like you're handing that over to the broker unless you blow up and you go casino style. So I think managing that, people should put margin in to take those positions. That seems fair.
Absolutely agree.
Yeah. So Rowan, you told me yesterday that you think this event could have been prevented in a way, from the retail perspective at least, with a better awareness.
Yeah, we've got quite limited exposure to what's been just discussed, since we are looking at the retail side and at the front-end side of the business. So let's say the margin requirements are not affected to the retail users unless the underlying companies blow up. So the point I've raised yesterday has been that this case of gold rally has been a very telling case of why we've started developing the platform like TradingView in the first place. Because the reason why the margins have become a systemic risk, a business level risk in the start of this year's quarter has been because the retail users price action has picked up quite late to the rally. And the reason for that is that the average user is still unable to identify the topic on time. Then he's thinking that it's not on his plate, and he would be rather better off not participating in the market action. And then when the market becomes too much convincing, he starts getting into the market, but that's already too late. I've got, let's say, a personal experience discussing the markets with non-industry friends, and very sadly to me, too many of them had entered the market only after gold has hit 5K, which is obviously, to everyone sitting in the room, is too late to take action and participate in the market. So the point for us to providing all of these tools is with a positive expectation that they would eventually drive the user awareness and let them identify the trends at a much earlier stage. So we could discuss what's been happening in the oil market in March, what's currently now starts or continues brewing with the AI stocks on the US and Chinese stock markets. But still we are seeing that users are participating quietly.
Well, one thing I would just add to that is
Yeah.
something Emmanuel was saying earlier about being a bit of a powder keg. When it comes to gold, it's a very traded product, and there's a lot of brokers out there in a competitive space offering different trading conditions, which probably don't help. So when you're asking the question of could this be stopped or prevented, when there's a strong competition and people are offering 1,000 to 1, 2,000 to 1 leverage, and other products similar to that, all they're doing is then fighting to attract more of the same business. So it was building to something that was inevitably going to have a change in direction.
Yeah, competing on risk conditions is dangerous, right? And
correct.
the saturation of the market, so many brokers, there's not too many liquidity providers that actually have direct access to the interbank market. Like this whole industry is probably fed on like a handful, maybe 10 providers, and then everything else is just recycled from there on. So when these people are then forced to compete on risk conditions because they're only so competitive they can get on the commercial side or race to the bottom, there's no tighter that they can get. I think that's the powder in the keg. And I think in January especially, there was a lot of, particularly prime of primes or even sort of people maybe 2 or 3 layers down that had given out more NOPs, net open position limits to their clients than they had available with their counterparties. And I think there were a lot of brokers out there that thought they had hedging facilities that weren't actually there when they needed them. So yeah, I think that's something, it's not so much preventing another market move like this, but I think for new brokers in the industry or those thinking to split out and start their own shop or even the shareholders in the UBOs, I would urge them to properly consider the risk of their capital. And it's not just can you hold on to B-book risk and survive the swings, it's can you actually hedge when you need to, and do you have the right counterparties that can offer you facility to do so.
Do you feel that there's a change towards gold as an asset, as a definition? I hear a lot of comparisons to Bitcoin. Gold is a new Bitcoin, Bitcoin is a new gold because of gold is so volatile and people buy it for long term. So is it possible to compare the two?
I would personally say no, I don't see the correlation between those two. I think one, gold is the store of value when there is more geopolitical happenings in the world. That's what people are turning to. I think originally when Bitcoin came out, people thought this would be a store of value.
Yeah.
And they've realized pretty quickly that that's not necessarily the case. So,
but is still gold store of value?
I believe so still. That it will generally be in a similar direction. But at the same time, when we get to the end of these geopolitical decisions that are happening right now, we've seen the US unemployment rates suddenly come out. There's an end in sight. And the Fed is saying they're potentially going to raise their rates. So I think people are now getting back to investing back into gold, into dollar and other currencies. So I think we will see some of those investments that were into gold come back out and then go back into the G10, G20 products. But also with what's happened in the Straits of Hormuz, that's where India, and you mentioned India earlier on today, Emmanuel, they run a lot of their business collateralized by gold. And when gold's expensive, hard to maintain, but the oil price has now gone through the roof because oil is obviously used heavily in India. I think you're going to see a bit of an off-sell on the secondary market from India in. So I think that's going to drive pricing down.
If you look at the price action of precious metals versus Bitcoin or digital currencies, I mean, in 2001, gold, we would get excited if gold moved $3 or $5 in a range in 24 hours. It was trading around $300 an ounce. So that was around 1-2% move if you're lucky. Silver was always moving up to 10%. So silver, the price action reminds me of what digital currencies do now. They move huge ranges. Gold now can move, 10% if it needs to. But that's what the similarity is, that silver was always like that. Trading silver was always like trading, a random digital currency. And so gold and silver have been called a currency as a broker. We've had them on our books as a currency. Gold and silver, platinum, palladium, we treat them like a currency. We talk about their yield in dollars per million rather than in cents per ounce. And so it already is a currency. It already is like, digital currencies, the price actions are similar. And we're seeing larger ranges now than we ever have before. What was 1-2% back 25 years ago is now, 5-10% in a day. So it is starting to move that, and it comes down to access. Like I said before, there's more people accessing the market, the gold price, and there's no more suppliers. So there's always going to be...
There's no more supply.
It's a finite resource. And so I predict volatility to increase with access, which is counterintuitive because, the market tells you that you want to have more access so markets are more efficient. But if that means higher volatility, and if you're a hedge fund or if you're a mum and dad trader or an investor and you've got gold now sitting in your self-managed super fund or SIP, your pension fund, do you really want that volatility? Probably not. So that's the way we're going. The volatility, in my opinion, will continue to act like digital currencies, and it's probably going to get worse.
And one interesting point that we found I found looking through this is that in January, when it sort of showed the momentum-like behaviors with the Bitcoin retail clients adding to longs as they were increasing in asset value, which you can sort of see with Bitcoin, but don't agree that it is now the same. And we actually it was a small cohort, but there was a number of brokers that remained short all the way through January. So I think it'd be a mistake for brokers to think it's just a buy and hold asset. To Emmanuel's point, volatility is definitely going to be increasing.
So do you see another asset taking the place of the safe haven, non-volatility asset instead of gold? Or
to complete on the previous question first. Yesterday's been the Fed interest rate decision, and I think it's been very nice capturing moment, seeing gold and Bitcoin trending down in the same direction. And if you analyze statistically, the assets are correlated in terms of the direction of their price action, but I would not say that gold tends to become as volatile as crypto is, because volatility is one of the base artifacts of crypto markets, whereas what happened to the gold has been a one-off out of the normality event, which had been a critical event to some elements of the industry. And once we are back on a regular track, we are not seeing gold and silver volatility to be anytime soon. And to complete on the recent question, I've personally made the wrong assumption on the previous talk in Q1 this year, when I've expected that oil will become the following asset, basically repeat the overwhelming user interest and user activity in the segment. What we are seeing is that oil is looked by just about 20% of the total audience as compared to the gold market, and it's never come close to the peak levels of gold, even during the unfortunate March events around Iran. I think we've been trying to understand what the reason behind that, and I think it again comes back to the price action, because what gold has been able to demonstrate and propose to traders, including retail traders, is a massive trend following opportunity, whereas oil has provided an enormous volatility in both directions. And this apparently is not seen compelling or inviting for the users to participate. They are definitely interested in a trend following opportunity rather in a volatile opportunity. So now if we are thinking what could be the next trend following opportunity, I think we are looking at the stocks of AI-related companies. So, like starting from Dell and HP, going to IRM, SanDisk, and Micron, the price action in just the recent quarter has been astonishing. Like we are talking about 5x, 7x. So this outshines even the crypto alt season. So it would be curious to see during the, let's say, next opportunity as we meet to speak, to see how this upcoming trend of AI stocks has developed in the second half of this year.
Interesting. AI stocks against gold, which is like the classical oldest asset, maybe gold, towards the AI, which is like the new hype.
I believe that would be like a short-term story, but we are still yet to define what the short-term could be. I believe that like this would be lasting for at least 3 years.
I think that's a scary outlook. That the store of value shifts from gold to the current AI stocks, but that's just my opinion.
I saw a refinery offering investment bars in copper recently, which I thought was a bit strange because I've got a big bag of copper coins at home, and I'm hoping that that's worth a few $1 million at some point in the future. But I don't think there's going to be a replacement for gold, and I think Bitcoin is the digital version of that. I don't think that's really going to change. I mean, people look at US dollar as a safe haven at some point in time, so you see the price action in gold go up, and then they need to sell gold to take dollars and pay for other things in downward markets. So, it'll still continue to shift between gold, US dollar, maybe if that retains its position in the global marketplace, and also Bitcoin, I think.
Okay, maybe we can conclude. I see that we don't have much time with. After all, this panel is called Rally or Retreat, so maybe each one of you would like to give us an estimation about the near future. Rally or retreat with gold?
I think for now it's going to continue to retreat, but we've gone up 40% from this time last year when we were all here together. And today, since end of Jan until now, we're about 15% down. I think there's still going to room to continue trending downwards for a little bit longer. But yeah, the volatility, I think you guys were saying earlier, the volatility is still going to be in the market. Mm-hmm. But I think for now it is going to trend down for a little bit longer, and then it will find it stable.
Mm-hmm. I'd call for the rally based on the underlying numbers of actively participating users, which remain close to the peak. They would drive market back up and to the further highs.
Yeah, long-term gold's always going higher, scarce resource, high demand, safe haven, and also the world's getting a more dangerous place. So I think long-term and medium-term gold's going up at a slower pace than what it's done in the last 12 months, though.
Slower pace.
Yeah.
Yeah, the only thing I'm sure about is that volatility is going to remain. So I think for like retail brokers, they should be focused on making sure their models can survive it, whether it's up or down. I think that's the most important thing for them. And when it does move and they do need to hedge, having the counterparties that have credible limits and they can do so safely. So I think that's the key focus for broker dealers.
Mm. Any questions from the audience? John?
I don't have the neck one. Can you hear me?
Yep.
You're getting one.
Okay. Hey, thanks for this important display of insight and knowledge. And maybe it was brought up before I entered. I wanted to ask about perpetuals, perps. I looked at some data, and it seems to be that gold perps had 6.9 billion volume, something like that. weekly in Q1. So I wanted to ask, does it change the way you operate? Does it require new relationship, new agreements with retail brokers if we'll see larger spread of gold perps? Thanks.
If you allow me to start, and thanks for the question, I think it just expands further the total addressable audience into the crypto-first traders or crypto-only traders. During last year, and during this year as well, there has been an impressive and consistent support from Tether introducing and bringing into the market their XAU-backed XAU-T instruments, which had been actively picked up by all major exchanges and participants. So as an outcome of your observation, we would definitely see further extension of users participating in the gold markets.
From my point of view, the gold perps is just another wrap around the same underlying price action. So I'd say in terms of does it change your relationships, I would just encourage you to be speaking to your perp provider and making sure they have the same strength and counterparty that you might get for your spot gold. And just knowing that, yeah, the market access is there and that they are a stable counterparty that you can transact with if you need to hedge your perps exposure. But to me, it doesn't really, whether it's a perp, a CFD, physical, forward, or one of the futures, like it's the same sort of underlying macros, I think, that we've discussed.
Okay, anything? Any more? Okay, thanks guys.
Thank you.
Thank you.
Thank you.